Here's the global picture. 2017, I had to really dig to find these damn figures, okay? And I've upped that. Here's the original analysis I do. Conservative, what it would take to deflate bonds and stocks and real estate back down to reality. And now I've just upped it recently because I don't have these figures updated, but I've updated for what I know is about the 525 trillion in financial assets. By the way, most important number in the world right now, 525 trillion of assets, 6.5 times global GDP, way off the charts. It should be like 2. And debt, 281 trillion, 24 trillion just added with COVID and more coming, 3.3 times global GDP. And it's going to deflate at a minimum. I'm being conservative here, okay? Original calculation, 205, this calculation updated for a little high, $225 trillion, 3 times the global GDP roughly of about 80 trillion, disappears. That is deflation, and I will leave the country and move to Mars if I'm wrong about this. That much assets deflate and you don't get deflation, then I'm the dumbest person on the earth. Gold. Everything bubbled. We've been in the biggest bubble in history in money printing. Gold bubbled up. This chart shows not quite as steep, but over a similar time period, within 1 year, gold went up, 7.6 times? I can't see this because it's covered. And the NASDAQ went up 11. Gold bubbled too. I've always been debating people in the gold, and they say, the gold buds always said, well, look, the bubbles in money printing. I said, well, gold's in a bubble, damn it. And gold's going to have to reset to reality, and then it'll grow again. And by the way, when does gold grow? Historically, 30-year commodity cycle is one of the best cycles out there, most consistent. We peaked in 2008. Gold came later because of the money printing, and silver. But the next one is 2040, and this one shouldn't bottom till at least 2023, something else I've been forecasting a long time. 2008 to 23, the normal way that happens without endless money printing and quantitative easing, which did not really exist substantially in history. You have the big crash first, 29 to 32. Oh, most of the assets go. Same thing with Japan, 90 to 92. Stocks routed, real estate routed, take down the financial assets and the debt as much as possible. Japan didn't do the debt, and we did in the 30s, okay? That's the normal way. Big crash, 30, 32. You have a stimulus program that gets you back up into 37, and then you have a final deep recession or lesser depression into the end of the winter season. This time we're going to get the opposite because of this 90-year cycle, which hits later than our 80-year demographic cycle in winter, and this bubble being extended so long. We're going to get the big crash, by my view, from 2021 into 2022 or 23, and stocks are going to go down 80, 90%. But again, just to get a preview, what happened in the mini depression in 2008? Gold did better first, held up in the early stages of down, but when things really got ugly with Lehman Brothers, dollar goes up 27%, bonds go up 20, 30, 40%, depending on the duration, and gold goes running to mommy, okay? We started to see a depression-like scenario, and that's when they really turn on the spigot chart now. And here's the good story for gold. Gold goes straight up, much faster than bonds. We're coming out of this with massive money printing because it is favored by that. And at least we get a tiny bit of inflation. And bonds take a while to go down, but eventually they go up when monetary easing pushes down bond yields. But the point is, at the worst of the crisis and into the most important part, it was the treasury bonds that were the safe haven, not gold. Gold looked like it would be until it saw deflation. Trend line through the 230-year cycle tops, 1980, that was the biggest, as Jim said. That was the biggest granddaddy because that was the strongest inflation, and gold correlates more with inflation than anything. And Bitcoin doesn't, by the way. You want an inflation hedge, it ain't Bitcoin, it's gold, okay? I'll agree on that. The trend line up through here would be about 2,200. I could have seen gold in the early stages of a stock crash, like in 2008, continuing to edge up until they saw that deflation. But you know what? I'm not seeing that now. It's already underperforming and is about to break out of a potential head and shoulders pattern on the downside. So we'll see. I think gold may have a little bounce here. And if it goes to 2,200, I'd be telling people that's where to cash out. And that's still a possibility. I do not see gold going to 10, 12, 15,000 because deflation does not favor gold. Gold is the best single inflation hedge on earth. Real estate is too, but it's more complicated. This is an important point here. If we see this, and Jeremy Grantham is saying something very similar, somewhere between now and May, I agree with him, we're going to see a top, and the next crash is going to be the steepest we've seen yet, and that's when I think people lose faith in these dumbass, academic, never had sex, never run a business, central bankers, okay? They're going to lose credibility because they're going to want to print 20 trillion next time. I think they're going to start to lose credibility, and people are going to finally see you don't get something for nothing by just printing money. The economy keeps getting worse and worse, not better and better, despite brief new highs. And guess what's the safe haven? What's the last thing to know? We've had the greatest bull market in treasury bonds ever with falling rates, following the greatest bear market from the late 30s, early 40s. I've been projecting back decades that by the end of 2022, we would see the lowest treasury bond, risk-free bond yields of our lifetimes. And then they would turn up into the next spring boom and mild inflation cycle. If you believe me, you should be in treasury bonds. And what's the better bonds? That 30-year. Look at this, 10-year bond. If I make assumptions a little deeper, and this is a conservative too, than we just saw in the flash crash last year, February, March, that the 10-year goes to 0 and the 30-year goes to 0.4. They went to 0.7 and 0.4 last time. So this is not, it'll probably be worse than that, maybe negative. 10-year would make 9.5% appreciation, 30-year 38% from locking in these measly 2.2% yields when they go to 0 for 30 years. That's how you make a lot of money. Zero coupon, a little more leverage, 40, almost 50%, and the TLT average 20-year, 22%. So I say buy 30-year treasury bonds or zero coupon. That is the best safe haven. If we do get inflation down the road, you can play gold and other things then. I say, and I'll stand by this, deflation comes first when $525 trillion of financial assets and $281 trillion worth of debt eventually has to deleverage.
To change your